Hi everybody, welcome back to another video. It's been a while since I last did an analysis on this REIT, and that is Fraser Logistic and Commercial Trust. For those who are new to Fraser LNC, they are, like the name said, it's a logistic and commercial REIT. Fraser LNC recent results has been good, but their dividend is still dropping. It is a prime example of how foreign overseas REITs have a huge factor, which is foreign currency risk. Even though Fraser LNC is known for very low leverage ratio, there is one big concern they have with their debts, which I'll highlight later in the video. So for those who are not familiar with Fraser LNC, they are a logistic and commercial REIT with 99 properties in L&I while 8 properties in commercial. And the management have actively been trying to expand into logistic and industrial side because it's a much profitable and much in demand as compared to commercial. Most of their assets are overseas with only one property in Singapore, majority in Australia, and have recently expanded to UK and Europe. Because of this, if Singapore currency gets stronger over time, the dividend you received in other currencies will naturally be lower as they are converted from Aussie dollar or UK dollar back into Singapore dollar for you to receive in SGD. That is not good for shareholders. Of course, we should not understate the performance of the REIT because throughout the years ever since it's listed, they have constantly done well with the high occupancy and low leverage ratio. So let's take a look at their results. Looking at their financial highlights, the rental reversion has been good with 18.9% overall throughout the whole year, throughout the portfolio as well. Occupancy is at 96.0% with logistic and industrial side having full occupancy for 4 consecutive years. Now you can understand why the management favors L&I side much more than commercial side. So the leverage ratio is at a healthy level of only 30.2% with interest coverage ratio at 7.1 times. That's much higher than most of the REITs, where due to the current high cost of interest, their leverage are averaged at about 40% with interest coverage ratio average of about maybe 4 to 5 times. So at 30.2% and 7.1 times, for Fraser L&I it's much lower. But later on, we will see the debt profile which will have some warnings to take note of. Currently, they have a healthy fixed rate borrowings of 77.2%. with cost of debt only at 2.4%, which is much lower also as compared to the rest of the REITs, which are currently increasing to about 3%. Similar to the past few quarters results, the management have constantly talked about having more L&I acquisitions, and they have made a new one in Netherlands with 12.7% discount to valuation. And I'm surprised at this kind of environment where L&I industries are in demand, they are still able to buy properties at a cheaper valuation. Now let us take a look at their recent results. As you can see, the lower revenue and NPI is common for all REITs. And if you look at the reason, it's due to weaker exchange rates, especially for Australia dollar, lower average occupancy at Maxis Business Parks and 357 Collins Street, which is actually the commercial properties, and higher utility expenses, which is also another common expenses that is increasing for all REITs as well. The decrease was offset by additional assets acquired throughout the year, with 4 properties in Australia and new assets contributing to the total revenue. The increase in finance cost by 29.7% year over year is expected due to higher interest rates. Another change is that the net change in the fair value of the property investments have dropped by 358 million as compared to last year, which increased by 425 million. This is common for properties because due to higher interest rate, the property valuations naturally comes down. Overall, at the current share price is around 6.18 dividend yield. Now, I feel that in the next year or two, the finance cost might increase significantly. This impact cannot be understated as it can be seen from Keppel DC's REIT's recent financial results where their finance costs increased significantly. that cause their DPU and definitely their share price to drop. Of course, if the REIT is good and the share price crashes, it provides an opportunity for you to buy. This slide is very important. If you see this statement, no refinancing is required for first half of financial year 24, with over 98% of them in second half that would need to be refinanced. Even though next year interest rate might come down, there's a risk that they do not come down fast enough because currently Fed is estimating a cut of 0.75%. That would mean that the average interest will still be at 4.25%. Similarly to many REITs that needs to refinance, this is a very big problem. So with the amount here, imagine that the loan is currently at an average cost of debt of about 2%. At the current Australia interest rate, it's at 4.35%. So this means that once Fraser L&I refinances, expect their cost of debt to increase. This is because these refinance loans would have their interest payment increase from 2% to interest rate that is higher than 4.35%. This would cause their financial costs to further increase based on the previous balance sheet, while their interest coverage ratio will continue to drop. Keppel DC REIT is a prime example where their cost of debt shot up from 2.8% to 3.5%, and that is from just refinancing 4.9% of their debts. So this is one of the main concerns with Fraser L&C is because this might be a catalyst to cause shock to their share price when they will have to refinance the huge amount of debts that is in financial year 24 and 25. On the brighter note, the leasing activities have been performing well, especially in the logistic and industrial sector, with the average reversion throughout the year at 19.9%, while Q4 have a very high rental reversions of 33.5%. And this is good because this means that the rentals that they are receiving is increasing. Whereas commercial has also improved and turned around with 9.2% for the quarter, while full year at 12.3%. This brings about the overall to be 18.9% on average for the full year. Looking at the logistic and industrial portfolio valuations, if noticed, the overall has dropped by 2.8%, while the Australia properties increased by 1.4%. German and Dutch properties dropped by 7%, while UK properties dropped by 13.8%. If noticed, the Australia properties have increased while the rest decreased, and this was partially due to the rental reversions that occurred when the tenants renewed their leases. If we look at their commercial property valuations, it does not look as bright as the logistic and industrial trust. Overall has dropped by 8.8% overall. Australian properties have dropped by 9.2%, while UK properties have dropped by 20.6%. If you can see, the Singapore properties is the unique one where it increased by 2.4%. So this shows how resilient Singapore office market is as compared to the rest of the world. With the risk-free rate from Singapore government bonds and treasury bills to be about 3 to 4%, you have to determine whether for REITs, what is the appropriate dividend yield that you would want so that you are taking in the risk but expecting a higher return or an appropriate return. Previously in my REITs tracker, when the share price were all in the lower range for all the REITs, my dividend yield expectations was all in the green with dividend yields higher than 5.5%. However, if you see, some of it has actually dropped to the yellow category, where they are giving at 5 to 4.9%. So when it comes to buying REITs, it's very important to buy at a right price that you are comfortable with the yield. So if you like this video and you would like to support the channel, please hit the like, subscribe and comment on which other REITs that you want me to work on next. Thank you, and I'll see you in the next video.